Welcome to the Capital News. I am your host, Alex Kreitis. Today is Friday, May 7th, 2021. Thank you so much for joining me. The title of today's podcast, April Fool's Job Report. But before we get to that, I just want to send a shout out to my grandma whose birthday it is today. Happy birthday, Gram. Love you very much. Think about you all the time, and I know you listen daily. And for those of you who may be curious, if we ever should start some sort of revolution, my grandmother may be on the front line. So be on the lookout for her. Happy birthday. We love you. So April Fool's Jobs Report. April Fool's because the number that was anticipated was around 1 million. Well, the number came in at 266,000. Now, you don't need to be a mathematical genius to understand that that's a big gap. That was a big miss. That was a huge miss. How could all of these market analysts and economists be so far off? What's going on here? Is this just simply a phony statistic for a phony number, for a phony narrative that they have to continue to peddle? Because as we stated yesterday, if we did get that, quote-unquote blockbuster number of 1 million, and some people were arguing that it might even have been a little bit more than 1 million jobs in the month of April, well, then the Federal Reserve might find themselves in a very hairy situation. They might be more trapped than what they already are. And we laid that argument out yesterday. But it basically comes down to, if this recovery is well underway, of course I argue that it isn't, but that's not the narrative that they're pushing. So if they want to continue to say that this recovery is well underway, well then, that data point, should it have been 1 million jobs or close to it, that would have validated their argument a little bit more. It would have been a data point to point to. And then you could have started asking those questions once again. If everything is back on track, then why do you continue to flood the system with liquidity? And then on the other side, you could ask Congress and the White House, well, why do you have to continue with more fiscal support? Everything seems to be A-OK. Well, their narrative is that we have to do more and more and more and more. More fiscal policy, more monetary policy. Now, what could give them some more time? A number that comes out at 1 million or a number that comes out at 266,000? Okay, you don't have to be a genius to connect the dots here to see what's going on. All right, we're obviously going to get to the report. We're going to go through it in its entirety. Want to get to some market performance and then ask another question related to housing and student debt, just to sort of tie that together too. Because we've been talking here this week about housing, inflation, all that type of stuff. And we've mentioned student debt here many times before on this podcast, so I just want to tie it in as to what might take place, because the Democrats have been talking about some form of student debt forgiveness and how that might play in to the housing market and the overall economy. So market performance for the day, we have the dollar selling off. So the dollar index is at 90.23, pretty much a bloodbath for the dollar today across all major currency pairs. The euro is up, trading at about $1.21. The British pound is almost at $1.40. The Aussie is about 78.5 cents. And even the sell-off of the dollar against the Chinese yuan continued and actually came down about 0.8%. So the dollar got decimated today on the back of this news. But as I stated yesterday, as far as the markets are concerned, there is only fantastic news, only great news. No bad news, no terrible news, not even good news. It's great or fantastic. Well, 266,000 was a huge miss from the 1 million. Markets, that's fantastic news. Great. If it was a huge miss, that means that Congress has to do more, and that means that the Federal Reserve has to do more. And not only do they have to do more, but they're going to do more. That's the belief. That's what these markets want. They are addicted. This is that monetary methadone. This is the crack that these crackheads want, and they're going to get it. So the markets rallied. And it's not like it really makes any much of a difference, because we've been witnessing this phenomena. It doesn't matter what the data comes out at. Markets just want to rally. We've seen terrible jobs numbers. We've seen terrible initial jobless claims figures, and markets continue to rally. We've witnessed this for over a year now. But the Dow is at 34,823 points, put on a gain of 0.8%, as did the S&P 500, as did the NASDAQ 100. I'm looking at a sea of green here, internationally here, with all of these equity markets, the only exception being a down day for the Chinese stocks, down 0.6%. And that very well may have been on the back of a strengthening Chinese yuan. Commodity prices, we have WTI, $64.90 a barrel. Brent, $68.24. Natural gas, $2.97. Gasoline, $2.13. Gold, $1,830 an ounce. Silver, $27.42 an ounce. Both closed up for the day. I want to continue to see this type of strength well into next week with both gold and silver. And if we continue to witness it next week, I think we got a lot more room to run to the upside. Copper continuing its ascent, putting on a gain of over 3% for the day, $4.76 a pound. And you can't forget lumber. Lumber continues its march higher as well, $1,702 per 1,000 linear board feet. $1,702. This thing is just skyrocketing to the moon. You know, I was somewhat tongue-in-cheek the other day when I said, all right, after we got that new report from the National Association of Home Builders saying the additional cost associated with new construction is $36,000, I said, hey, it was $24,000 back in February. It's $36,000 now. We continue to see this type of trend. Maybe over the summer, it's going to be $56,000. Okay? If this price continues, if we get lumber at the price of gold or at $2,000, maybe even more, that's what it's going to be. That's what it's definitely going to be $45,000. It's not going to be anything else to put another $10,000 on it at these rates. It's going to be completely bonkers. And it's just going to continue to push people basically further out onto the risk curve on the type of mortgage that they're going to have to take with all of that excess borrowing. Or they're just going to be completely priced out of the housing market. End of story. Uncle Sam's 10-year junk note is yielding 1.58%, and it did sell off quite a bit, meaning bond prices caught a bid because there was concern, so there was a flight to safety. Bond prices up, yields went down, actually went below 150 earlier in the trading session, but did recover later in the day. The point I want to make about housing and student loan debt is the following. Should we have some form of student debt forgiveness? And of course, I am 100% against this. That's your responsibility. You cannot put that on the back of a bunch of people who have gone to school and have paid off their student loans already, and people who have decided that college wasn't for them. They shouldn't have to bear the cost because there's no free lunch here. That's who would pay it. That debt would basically be added to our national debt immediately because it's owed to the government. That's why the government thinks, well, we can pass a law and we can forgive all of this debt. And of course, just like everybody thinks these stimulus checks are manna from heaven, that it's only good, they're not really realizing the negative consequences on the other side of this, which of course we're starting to witness now with all of these consumer prices moving higher or expected to move higher because it's one major corporation after the next conditioning everybody, saying, look, our prices are going to go up, okay? And again, don't just pay attention to the price, but the quantity that you are receiving, because your quality is also going to go down. Inflation is a nasty beast. That's what I've been railing against. That's why I've been against all of this before it even began. It's not that difficult to figure out what's going to happen. You just have to have the nerve to say it, I guess. But there's just not enough people out there who are against all this stuff. Again, 96-0, no votes for America. Nobody cares Act 1.0. But if you have student debt forgiveness, really of any degree, what are a lot of these younger people going to do? Because an excuse, and a reasonable excuse as to why they might be putting off starting a family or buying a home is because they have all of this student debt. $10,000, $25,000, $50,000, maybe even six figures worth of debt. Well, now if that gets eliminated, or significantly eliminated, now they can't really use that as an excuse, if you will, to say, well, I can't start a family or I can't go buy a house because that debt is gone or it's greatly diminished. So now you could potentially have an influx of demand by younger people who now have their student debt loans wiped out or greatly reduced. And I say, I want to go buy a home because I don't have this debt. I can now start to save up as a result of it. And who knows what the government might do with first home buyer tax credits. Okay? So this is going to have the same effect that all these stimulus checks have had, plus all of this monetary and fiscal policy bonanza, and it's going to jack prices higher. So I've said here consistently with this recent quote-unquote boom in the housing market that it still has legs to run, even without any type of student debt forgiveness, just based off of the supply and demand dynamics of the market. There is demand for housing. There's not a lot of supply coming onto the marketplace. Furthermore, a lot of the home building that is taking place, it's luxury apartments and it's mid-tier homes, so it's your higher selling price homes, or it's your luxury homes. And the reason they're selling and building those homes is because that's where they get their margins. Well, younger people are not that segment of the population. They don't have that kind of money to purchase those types of homes. Massive dislocation when it comes to supply and demand. There's just not going to be enough supply on the market of existing homes, and home builders are not going to be able to keep up with that demand, nor currently are they even building those types of homes now in a large enough capacity to meet this rising demand. Definitely should it occur because of student debt forgiveness. So what's going to happen are prices are going to continue to spiral upward. They are going to continue to feed higher and higher and higher. I mean, that's what's taking place right now. A lot of people are saying, look, I was still working. I never got laid off. And even if they did get laid off for a period of time, they were making more money, laid off a lot of people. And again, people that didn't get laid off still got these checks. If they had kids, their kids got the checks. And they said, well, let's go buy a house. We got all this extra money. If we got to go above ask, we can do it because the government just gave us all this money. And that's exactly what we are witnessing. Plus, because of all the funny money, private equity, pension funds, hedge funds, you name it, are coming into the real estate market. And they're buying homes sight unseen, no inspection, thousands and thousands of dollars above ask, and for all cash. So this thing still has room to run. These prices can get completely out of control. And with it, you're going to have further demand for all of these building materials. So yeah, lumber might be at $1,700 right now. It could go much higher if we continue to see this type of demand for these types for homes and for other products as well, because that extra money now that is basically in the pockets of all of these people around the country because they're not paying off their student debt because they don't have it, it's going to have the same type of upward pressure on so many other goods and services around the economy. There is no free lunch, but people can't connect the dots with this. And it's a true shame because a lot of people who want this student debt forgiveness presumably got an education. They earned an education, but clearly they cannot figure this out. Again, folks, last year, that podcast, Free Was Never So Expensive, check it out. We were well ahead of the curve on all of these topics coming to fruition. And we ain't seen the worst of it yet, believe me when I tell you. So the employment situation, April 2021, out of the Bureau of Labor Statistics. Total non-farm payroll employment rose by 266,000 in April, and the unemployment rate was little changed at 6.1%. This is out of the household survey data. Both the unemployment rate at 6.1% and the number of unemployed persons at 9.8 million were little changed in April. These measures are down considerably from their recent highs in April of 2020, but remain well above their levels prior to the coronavirus pandemic, at 3.5% and 5.7 million, respectively, in February of 2020. Among the major worker groups, the unemployment rates for adult men came in at 6.1%, adult women 5.6%, teenagers 12.3%, whites 5.3%, blacks 9.7%, Asians 5.7%, and Hispanics at 7.9% showed little or no change in the month of April. Among the unemployed, the number of persons on temporary layoff at 2.1 million changed little in April. This measure is down considerably from the recent high of 18 million in April of 2020, but is 1.4 million higher than in February of 2020. The number of permanent job losers at 3.5 million was also little changed over the month, but is 2.2 million higher than in February of 2020. So that's a number we like to pay attention to. Permanent job losers remains sort of at a plateau level at the moment for the past few months at 3.5 million. So that's good that that hasn't gotten worse, but not great that it hasn't gotten better. So that's where we are with that. In April, the number of persons jobless less than 5 weeks increased by 237,000 to 2.4 million, while the number of persons jobless 15 to 26 weeks declined by 188,000 to 1.2 million. The number of long-term unemployed, those jobless for 27 weeks or more, at 4.2 million was essentially unchanged in April, but is 3.1 million higher than in February of 2020. That still signals to me there's a lot of stress that remains within the economy, plus with all of the stimulus checks and the added unemployment checks that are out there, people are just saying, well, it benefits me to remain unemployed. So that continues to feed into the narrative, and we'll talk about that after we get through the report, some of the political arguments that were made this afternoon. The labor force participation rate was little changed at 61.7% in April and is 1.6 percentage points lower than in February of 2020. The employment population ratio was also little changed in April at 57.9%, but is up by 0.5 percentage points since December of 2020. However, this measure is 3.2 percentage points below its February 2020. So the labor force participation rate and the employment population ratio are a couple other statistics that we like to take a better look at, and we'll do that next week. The fact that these numbers are a little changed bodes ill for any type of jobs recovery for the time being. So that's not good news. The number of persons employed part-time for economic reasons decreased by 583,000 to 5.2 million in April. This decline reflected a drop in the number of people whose hours were cut due to slack work or business conditions. The number of persons employed part-time for economic reasons is 845,000 higher than in February of last year. These individuals who would have preferred full-time employment were working part-time because their hours had been reduced or they were unable to find full-time jobs. In April, the number of persons not in the labor force who currently want a job was 6.6 million, little changed over the month, but up by 1.6 million since February. So that's also a number that continues to stagnate. That is not a good thing. These individuals were not counted as unemployed because they were not actively looking for work during the last 4 weeks or were unavailable to take a job. So don't forget about that point either. Once you're out of the labor force for a certain period of time, you are no longer counted. That's a significant number of people. Among those not in the labor force who currently want a job, the number of persons marginally attached to the labor force at 1.9 million was essentially unchanged in April, but is up by 419,000 since February of last year. These individuals wanted and were available for work and had looked for a job sometime in the prior 12 months, but had not looked for work in the 4 weeks preceding the survey. The number of discouraged workers, a subset of the marginally attached who believed that no jobs were available for them, was little changed at 565,000 in April, but is 164,000 higher than in February of 2020. Moving on to the household survey supplemental data. In April, 18.3% of employed persons teleworked because of the coronavirus pandemic, down from 21% in the prior month. These data refer to employed persons who teleworked or worked at home for pay at some point in the last 4 weeks, specifically because of the pandemic. In April, 9.4 million persons reported that they had been unable to work because their employer closed or lost business due to the pandemic. That is, they did not work at all or worked fewer hours at some point in the last 4 weeks due to the pandemic. This measure is down from 11.4 million in the previous month. Among those who reported in April that they were unable to work because of pandemic-related closures or lost business, 9.3% received at least some pay from their employer for the hours not worked, little changed from the previous month. Okay. Among those not in the labor force in April, 2.8 million persons were prevented from looking for work due to the pandemic. This measure is down from 3.7 million the month before. To be counted as unemployed by definition, individuals must be either actively looking for work or on temporary layoff. So the fact that that number is going down is a good thing. With the reopening, jobs coming back, that makes sense to see that number move lower. On to the establishment survey data. Total non-farm payroll employment increased by 266,000 in April, following increases of 770,000 in March and 536,000 in the month of February. In April, non-farm employment is down by 8.2 million, or 5.4%, from its pre-pandemic level in February of 2020. So there's still 8.2 million people that got to get a job to get back to where we were before all of this started. That is a huge number. In April, notable job gains in leisure and hospitality, other services, and local government education were partially offset by losses in temporary help services and in couriers and messengers. In April, employment in leisure and hospitality increased by 331,000 as pandemic-related restrictions continued to ease in many parts of the country. More than half of the increase was in food services and drinking places, a positive 187,000. Job gains also occurred in amusements, gambling, and recreation, up 73,000, and in accommodation, up 54,000. Although leisure and hospitality has added 5.4 million jobs over the year, employment in the industry is down by 2.8 million, or 16.8% since February of 2020. So still a lot of slack in that industry, which of course was one of the most hardest hit during the pandemic. In April, employment increased by 44,000 in the other services industry, with gains in repair and maintenance up 14,000, and personal and laundry services also up 14,000. Employment in other services is 352,000 below its February 2020 level. Employment in local government education increased by 31,000 in April, but is 611,000 lower than in February of last year. Federal government employment increased by 9,000 over the month. In April, employment in social assistance rose by 23,000, with about half of the increase in child daycare services, up 12,000. Employment in social assistance is 286,000 lower than in February of 2020. Employment in financial activities rose by 19,000 over the month, with most of the gain occurring in real estate and rental leasing, up 17,000. Employment in financial activities is down by 63,000 since February of 2020. With professional and business services, employment in temporary help services declined by 111,000 in April and is 296,000 lower than in February of last year. Business support services lost jobs in April, losing 15,000, while architectural and engineering services and scientific research and development services added 12,000 and 7,000 respectively. Within transportation and warehousing, employment in couriers and messengers fell by 77,000 in April, but is up by 126,000 since February of last year. Recall, transportation and warehousing has been on a tear over the past several months, which is why we are still 126,000 above that February 2020 level. But still, 77,000 fewer jobs in the month of April is a significant number. Air transportation added 7,000 jobs over the month. On to manufacturing. Manufacturing employment edged down in April by 18,000 jobs, following gains in the previous 2 months of 54,000 in March and 35,000 in February. In April, job losses in motor vehicles and parts down 27,000, and in wood products down 7,000, more than offset job gains in miscellaneous durable goods manufacturing, a positive 13,000, and chemicals, a positive 4,000. Employment in manufacturing is 515,000 lower than in February of 2020. That is a ton of jobs in the manufacturing sector. Again, 515,000 fewer than February of last year. Retail trade employment changed little in April, a minus 15,000, following a gain in the prior month of 33,000. In April, employment declined in food and beverage stores, down 49,000, general merchandise stores down 10,000, and gasoline stations down 9,000. These losses were partially offset by employment increases in sporting goods, hobby, book, and music stores gaining 20,000, clothing and clothing accessory stores gaining 10,000, and health and personal care stores gaining 9,000. Employment in retail trade overall is 400,000 lower than in February of 2020. And retail stores, unfortunately, a lot of these are classified as zombies, so we still ain't seen the worst of this yet. Employment in healthcare changed little in April, losing 4,000, as a gain as a job gain in ambulatory healthcare services gained 21,000, was largely offset by a job loss in nursing care facilities, down 19,000. Healthcare employment is down by 542,000 since February of last year. Employment in construction was unchanged over the month. Employment in the industry is up by 917,000 over the year, but is still 196,000 below its February 2020 level. In April, employment changed little in other major industries, including mining, wholesale trade, and information. In April, average hourly earnings for all employees on private non-farm payrolls increased by 21 cents to $30.17, following a decline of 4 cents in the prior month. In April, average hourly earnings for private sector production and non-supervisory employees rose by 20 cents to $25.45. The data for April suggests that the rising demand for labor associated with the recovery from the pandemic may have put upward pressure on wages. Since average hourly earnings vary widely across industries, the large employment fluctuations since February of 2020 complicate the analysis of recent trends in average hourly earnings. Again, then give us the median. The average work week for all employees on private non-farm payrolls increased by 0.1 hours to 35 hours even in April. In manufacturing, the work week and overtime were both unchanged over the month at 40.5 hours and 3.2 hours, respectively. The average work week for production and non-supervisory employees on private non-farm payrolls was unchanged at 34.4 hours. On to the revisions. The change in total non-farm payroll employment for February was revised up by 68,000 from 468,000 to a positive 536,000, and the change for March was revised downward by 146,000 from a positive 916,000 to a positive 770,000, a big revision. With these revisions, employment in February and March combined is 78,000 lower than previously reported. And then, of course, onto the fine print of the whole thing, yada, yada, yada. If it was calculated as it should have been, the unemployment rate would be 0.3 percentage points higher, which would take us to 6.4%. So there you have it. That is the phony baloney jobs number. Okay, and damage control, or whatever you want to call it, by the politicians today, by Joe Biden, by our Treasury Secretary, Janet Dingbat Yellen, coming out and saying, well, you can't just look at one data point. You got to follow the trend. So now, we're getting back to being data dependent, but you can't just look at one point. So we got to wait, right? So they're fitting their narrative. Joe Biden coming out and saying, look, that's what we're telling you, folks. This whole thing is very destructive. And could you imagine how worse these numbers could have been if it wasn't for the Federal Reserve, and if it wasn't for all of the fiscal policy that we've just implemented and all of the spending and all of the stimulus checks? Could you imagine how bad it would be if it wasn't for us? And then you have some members of the Federal Reserve coming out and saying that, we do think that the stimulus checks and the extended unemployment benefits is having an effect on this. People don't want to go to work because they're getting paid not to. So the Federal Reserve admits to this. They can do that because that's not a Federal Reserve policy. That's a fiscal policy. Even though the Federal Reserve monetary policy is financing this fiscal policy, it's not theirs. They didn't sign off on it, so to speak. They didn't, lobby for it, blah, 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 blah. At least not publicly. What they do behind the scenes is anybody's guess. But they at least financed it. But that's a fiscal policy, the extension of the unemployment benefit. So the Fed says, yeah, of course that's a contributing factor because they can pass the buck onto the White House, onto Congress, shift the blame. And then, of course, you have Congress and you have the White House, the Treasury Department, coming out and saying, oh, no, that has nothing to do with it, nothing to do with it at all. It's still the negative effects of COVID-19, and it's childcare. A lot of people have children. These child daycare centers are not open, or they don't feel safe sending their children there, so they can't go back to work because they don't have anybody to take care of their children. So they're arguing for more fiscal stimulus. Well, let's give more money. At least you can afford it, blah, 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 blah. This is the narrative. It's always more, more, more. This bought them time. This buys them another month until we get the May numbers. So they got another month, and who knows what's going to happen then. Anything could happen within a month's time, and I mean anything. But that's the narrative that we have to contend with. And yesterday we talked about the Fed's balance sheet being at $7.81 trillion, a week-over-week increase of $30 billion, just about $10 billion shy of an all-time high. And then the market continues to march higher because that is the true narrative, folks. Don't lose sight of the big picture. These markets continue to grind higher so long as the Federal Reserve's balance sheet continues to grind higher and the market continues to buy it. Once the market no longer continues to buy this narrative, then it's game, set, match. Because there's nothing left that can be done. Interest rates go up, loss of confidence, system exhaustion, a hedge fund or something else blows up because of credit risk and counterparty risk that nobody could see coming. Yeah, as they like to say, some sort of exogenous shock. Who knows? That's how fragile this system is. You get a little bit of an increase in interest rates, not from the Federal Reserve, not their policy rate, not the federal funds rate, but Uncle Sam's 10-year junk note. If that yield should keep moving higher, that's going to have ripple effects across the spectrum. And as fragile as the system is, it cannot take higher rates. Even though if you had a free market capitalistic system, I'm not going to predict where they would be at a concrete number, but I can argue pretty convincingly that they'd be much higher than where they are today. They have no business being this low. They are artificially there. This is the system. It is distorting everything. We are going to see a breakdown of so many correlations. Some of the correlations are already being broken down, but I've been talking about this for the past 2 years. Up is down is up, black is white, day is night. I mean, everything is going to flip upside down, and people are not going to know how to navigate it. Nobody. Not myself, not you. Nobody's going to know. I just think the best places to be are in precious metals because gold and silver has been here for thousands of years. This is not their first rodeo. Commodities, because people need this stuff to live. And to me, this is going to be a very rough decade, to say the least, if not longer. So you need the stuff that actually keeps you alive. You need the energy, you need the food, and precious metals as a hedge against social decay, currency collapse, all that type of stuff to preserve what wealth you may have. Okay, yeah, you might make money on it, or at least you preserve what you have. That's a good deal as far as I'm concerned. And there are other ways to play that if you want to speculate with the mining stocks or this, that, or the other. But you got to look into that for yourself. But there's no place safe at the end of the day when all of this stuff hits the fan. It's one protest after the next. It's one riot after the next. People can't afford to live. People are sick and tired. It's everywhere. And people think that this is a gift from the government. They are in for a rude awakening as to how expensive this is all going to be, what it's going to cost them. All this money that you've already gotten from the government is pretty much out of your pocket. If you wanted to buy a home or you wanted to fix up your home, do it yourself. You wanted to run to Lowe's and Home Depot every 2 hours because you keep forgetting stuff. It's expensive. All of it's out the window. And it's going to get much more expensive, and the stimulus checks and all this other stuff are going to stop. And we still have to contend with the moratoriums and the forbearances being lifted. What's that going to do? Okay, far from out of the woods. But that's going to be continuing the narrative of we have to do more. And if the Republicans should adopt that strategy that we talked about yesterday that was reported by Charlie Gasparino at a Fox, they're just going to say, hey, we're going to let the Democrats run wild. We're going to give them rope. Let them put their head in a noose. The problem, as I stated yesterday, it's not just the Democrats' necks in the noose. It's going to be ours, too. It's going to be the entire country. So I think this is a foolish and idiotic strategy. There's political logic to it, but it's political logic that basically just says, screw the country. Who cares? Because do you honestly think that the Republicans are just going to be able to undo everything in 2023? They might win in 2022. They don't get sworn in until 2023. And you're still going to have the idiots in the White House. You think they're just going to sign whatever the Republicans pass? Give me a break. So these people better wake up, but they're not going to. And so you better wake up, and you better leave these parties, because this is what they are doing to you, and this is what they have done to you. It's been the slow boil. Don't buy into their nonsense. Don't buy into their argument just because you don't like the Democrats, or don't buy into the Democrats because you don't like the Republicans. Leave them. They are destroying this country. They are stealing future prosperity and growth from younger generations who are struggling as it is. It's immoral, unethical, un-American, yet we keep doing it. And when everybody realizes how expensive it all is, it's going to be too late. April Fool's Jobs Report, there you have it. Enjoy your weekend. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Karitis. Godspeed.